Jay Powell, perhaps stating the obvious, saying that equity prices are fairly highly valued. He was asked about the risk of asset inflation. Let's get more from Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Great to see you.
You too. Thanks for having me on.
We've heard Fed chiefs say this kind of thing about asset values before. The market may listen for a moment, but not on a sustained basis.
Exactly. And so, I think every time we hit one of these milestones, like 30,000, everybody always asks the question. And the reality is, we've always had these questions, right? Remember when COVID happened, the economy practically shut down, but then the stock market took off. And then everybody thought, okay, well, what is it, like a disconnect between the markets and Main Street? And the reality is it's the same phenomenon that plays out all the time, which is if you look at tariff wars today, how are you fighting this tariff war? You're doing it by borrowing tons of money. Every government's doing it. And so what you're seeing a devaluation in every currency simultaneously. And so what happens is you get a rush to assets. And what's the easiest asset to buy? Stocks, right? Followed by bonds. Those are the fast assets you buy. Those are the ones that do well in the short term. And then it kind of moves on to different asset classes. But the reality is, so long as our only tools we have to fight a tariff war globally is, we'll borrow lots of money and we'll protect our own industries and our economy, you're going to see a continued rally in the stock market, followed by, we can't have high interest rates if you're going to continuously borrow money. So then, the Feds and the central banks are forced to cut rates, which is what they're doing now. And so, I get what Chairman Powell's doing. I mean, he has to. But ultimately, you can only dampen the upside pressure on that. There is no long-term solution outside of coming to a global consensus on, what is this new trading environment going to look like, right?
I mean, your advice, it's stuff we've heard before, but you say diversified and stay in liquid assets.
Yeah, I mean, not only liquid, but illiquid as well. And so, and so what we say is, the old 60-40 model, that's a broken model, right? If you're looking at your portfolio and all you got is stocks and bonds in there, you're missing out on a huge chunk of the market, the fastest growing chunk of the market, which is the private markets, right?
Okay.
And I think we saw that yesterday with OpenAI and NVIDIA, $100 billion investment. That is a monster-sized investment into a private company. Right? And if you think about that number rationally, that's probably bigger than the GDPs of a lot of smaller countries.
Oh, yeah.
Right? But that's one company making an investment into a private company. And so if you look at that industry, AI stocks, which is the fastest growing segment of the global economy, all of those companies are private. xAI is private, OpenAI is private, right? Anthropic is private. And so if you're not involved in the private markets, you're missing out on this huge growth opportunity by just sitting around in stocks and bonds, right? And so that's why when we say, be truly diversified, make sure you have all your asset classes covered. This old idea that you can just hold stocks and bonds, I mean, that's a broken model, right?
It is tough, though, for, private retail investors to get involved in private equity assets, so.
You are correct on that, but there has been a few changes in laws in Canada. So, if you find, an advisor who has a portfolio management license, they have the ability to accredit you as part of a broader portfolio. So there are methods and ways for retail investors to get involved, but they may need advice and they may need to find the right type of financial advisor that can help them do that, right?
You say that there may be a case for a thing you call the 25, 25, 25, 25 portfolio?
Correct.
What would that be?
Well, I mean, it's 25% stocks, 25% bonds, 25% cash, and then 25% alternatives, right? So it's a nice, broad, diversified mix. And the reason we say, it doesn't have to be cash, but it just has to be very short-term liquid assets like bonds. And the reason we say that is that cushions you against the private assets' lack of liquidity. Right? If you want to be in private assets, you have to understand it's a long-term game. You're in there for 5 years, 10 years. You don't know when OpenAI goes public. You don't know when SpaceX is going to go public. And you can't go screaming to your financial advisor saying, okay, well, sell the shares. Well, you can't, right? Like, it doesn't work that way, right?
Yes.
And so, if you're going to go into a private asset class, you need to make sure you have enough cash cushion to hold you there. You know what I mean? So that you can first liquidate the cash, then the bonds, then the equities, and finally you can get around to your private assets. Right? But you need to give whoever's managing that private asset sufficient time to grow it to the right size and then to take it public. Pressuring them to do it in a shorter term could end up in a catastrophe, right?
Traditionally, private equity would put money into companies and then hope to reap a big profit when they went public.
Correct.
Do you think we will see a bunch of IPOs, especially in the US, in the next year?
Oh, absolutely, absolutely. I mean, I always say, the pre-IPO market is built to go public, right? So if you look at venture capital funds, their very nature, their very structure is a 5 to 7 year lockup, which means at the end of 5 to 7 years, you need to give the investors their money back. The only way you can do that is if your company goes public and you can cash out or your company gets acquired. And so, every time the stock market rallies and, as we've got to these levels where valuations are very good, it's going to be harder and harder for management teams at these pre-IPO companies to say, well, I'm not ready to go public yet. I don't think the market's there for me. There's going to be a ton of pressure on them to say, listen, this is it. Do it now. We're not waiting around too long, right? And the other one is, of course, the idea of critical mass. So if you're a company, say, pick a huge one like OpenAI, which has tens of thousands of employees, at one point, if you only had like 10 large investors, 10 LPs, well, I mean, those 10 LPs can get along, you can manage them, you can deal with them, right? But once you have these tens of thousands of employees who also own shares, well, how do you manage that, right? It becomes a pain, right? And then how do you do the reporting requirements? Everybody's got different reporting requirements, right? Everybody wants different reports. At one point, you want to just say, okay, look, this is what I'm providing, right? Here's the rules, here's the laws, here's a standardized set of documents I'm providing to you, right?
So it's good, just do an IPO and it's simpler.
Exactly,
Jay,
exactly.
Thanks very much.
No problem.
Jay Bala, CEO and Senior Portfolio Manager at AIP.